host, Webster Tarpley, speaking from Washington, D.C. So it is July 1931, and the European banking system is poised on the brink of some kind of abyss, just as it was 79 years ago this summer, July 1931. All the German banks blew up, were shut down with bank holidays to protect them from technical, legal bankruptcy. We had nevertheless have had, despite the grave situation in the world economy, a kind of stock hysteria, a very peculiar phenomenon in the New York stock market this past week. One big day, 260, 270-point gains on the Dow. One perceptive analyst points to an atmosphere, a surreal, macabre circus. And in this surreal and macabre circus, he points above all to high-frequency trading as the thing that is going on, not small investors, but big institutional traders and, above all, computer-armed speculators. Points to the fact that, according to Lipper Analytical, $12 billion have left the stock market, left mutual funds, left these exchange-traded funds, these closed-end funds traded on the exchanges. And at the same time, about $19 billion of cash has entered the money market funds, which are supposedly the place to go if bad weather is expected. Demands, of course, for U.S. Treasuries, despite all the yelping from the reactionaries. Everybody in the world is piling into U.S. Treasuries. They have reasserted themselves as the safe haven refuge of last resort. And what you've got is some kind of action by the plunge protection team, the President's Working Group on Financial Markets, joining together with these exchange high-frequency traders, right, the market makers, and so forth, to start these stock hysterias going. Is it a mugs rally where the big money moves out and they expect the little people to move in so that the little people are left holding the bag when the bottom falls out? Some symptoms that situation is indeed very ominous and very grim. Last week, we had Citibank losing 17% of its stock value in about 5 minutes. It was halted. And you'll remember then that it was restarted. We were told this was a mistake. Baloney. This is high-frequency trading that needs to be banned, needs to become a federal crime, a felony. Then we had last week, credit default swaps indicated the second highest fear ever for Spain, Portugal, Greece, and the other Mediterranean tier, the Club Med of the Euro. We're told that according to those same credit default swaps, Greece has a 40% chance of going bankrupt, Spain a 25% chance of going bankrupt. On July 1st, a week ago yesterday, European banks had to pay back 440 billion euros to the European Central Bank, and they didn't make it. They were not able to make these payments. Rather, they had to get refinancing. There were several hundred billion euros that had to be issued as new credit by the European Central Bank to roll over these debts because they couldn't be liquidated, they couldn't be paid off and put to rest. And then maybe the most ominous of all, the European Central Bank last Tuesday, I believe, attempted to market 55 billion euros of bonds, of securities, and this was a failed auction. Ominous words, a failed auction of the European Central Bank. There are 55 billion euros of securities. They were only able to sell 35 billion, and the interest rate on this was much, much higher than they had ever expected. Now, this gets us back for something similar. I think we have to go back to March of 2009 when the British were trying to sell some gilts, their treasury bonds, treasury securities, and the auction failed. Everybody says, what happens if there's a failed auction of U.S. treasury bonds? That's very ominous. You don't want this to happen through the zombie banks and the hedge funds. But this has now happened to the European Central Bank. So now we're in the middle of the stress test. The attempt to drive down the euro has failed. In particular, as I think we've been pointing out, China seems to be buying euros. And we have this wonderful situation where the British are wondering how come our measures to collapse the euro and direct the forces of depression away from the pound and towards the euro. How come it's not working? I'm reminded once again of Admiral Beatty, the leader of the British battlecruiser squadron at the Battle of Jutland in May of 1916, when he said, "What's wrong with our bloody ships today?" Well, what's wrong was 3 of his battlecruisers blew up in the first half hour or so. 3 of his most modern and fastest ships simply ceased to exist. They were vaporized under shell fire. Today we can imagine the city of London saying, "What's wrong with our bloody derivatives today?" In other words, they're shooting all this stuff at the euro, and it doesn't come down. It's actually going up. And the key seems to be Chinese support. Now, that sets up a whole series of conflicts, but it means that the attempt to create a European banking crisis, of course, starting from the fact that many of these banks are bankrupt because of the 1/2 quadrillion or so of derivatives that they have. This now shifts into the banking sector itself. In the meantime, the German ban on naked credit default swaps stands. The Germans have come up with a bankruptcy law. This is called the Bankenrestrukturierungsgesetz, I believe. It is essentially what happens if a bank goes bankrupt, and the idea of it is this 111 pages coming from the German government, Restrukturierungsgesetz, which says if a bank goes bankrupt, if it's big, if it's systemic in its implications, the commercial bank is separated out and kept going, right? And those functions can be saved. But the rest of it, in particular, the proprietary trading derivatives desk, is simply liquidated under the equivalent of what we would call Chapter 7 insolvency, right? Bankruptcy liquidation, not reorganization, but liquidation. And they also want to have a bank tax for the expenses of doing this. Now, this is, at least according to the information we have so far, a positive step. There's also a role for this SOFIN and the head of that, Hannes Rehm, Sonderfonds für Finanzstabilität. That's part of the German proposal. So this is much more promising than anything happening on the European level. And it's also more promising than anything that has happened here in the United States. As we've already documented, the FinReg bill is a monstrosity. It's a bad joke. And we're even told that such remnants as there are of this Volcker rule, remember, what we needed was Glass-Steagall to separate rigorously banking from investment banking and speculation. That was then dumbed down and reduced to the Volcker rule. Then the Volcker rule was gutted in the last part of the conference committee. Those limitations seem to have been postponed in their introduction for more than a decade, for a dozen years, according to some readings of the bill. So this is very, very bad news, but the interesting stuff comes from the European front. So in the meantime, Trichet, the head of the European Central Bank, has introduced these stress tests, which we're going to talk about in the next segment. Not a good idea. Remember, the roots of the European crisis are the desire of the Anglo-Americans to save the dollar as a reserve currency by exposing and exacerbating the weakness of the euro, and doing this with hedge fund attacks backed up by publicity, backed up by the mighty Wurlitzer of the London Financial Times, the London Economist, and the rest of it. And foolish Trichet has decided to start his stress test right in the middle of this enemy attack on the euro. Bad idea. We'll be back in a minute here on World Crisis Radio.